Simon Maughan is Head of Sales and Distribution at MF Global. He's also been watching the events unfolding in the last hour, and he joins us alongside our reporter Elliott, Gotkine, who is still here with me. If we can begin by just looking at this issue of ring fencing. All the banking leaders have agreed that they can do it, that they're working on contingency plans should they be called to do it. They are saying, though, that the costs of doing it would be at the moment uncertain and unknown. Does that seem to ring true with you?
Well, what the banks are saying is that because we've got Basel III and we've got tougher capital requirements and we've got living will requirements and we've got additional liquidity requirements, that actually laying on additional regulation specifically onto UK banks is going to create incremental cost. And it's going to be very difficult to differentiate both the costs and the benefits of that ring fence from all the other changes that are taking place. Everybody agrees that it's going to take some considerable period of time to see if all of these measures are actually going to shore up the banking system and get to the ultimate goal, which is ensuring that taxpayers never have to put another penny into the banks. And therefore, the argument that the banks are really pitching is, you know, why throw a ring fence on top of all the other stuff when we don't even know if the other stuff is going to be enough or too much at this point?
Simon, it's Elliott, Gotkine here. Interesting, Bob Diamond, of course, owner of also a retail bank and an investment bank, talking about how the banks that failed in the UK, Northern Rock, Bradford and Bingley, Bank of Scotland, for example, were all down to normal lending out for property. Do you think that the Independent Commission on Banking has kind of, you know, missed a trick here in that it's separating retail banking from investment banking effectively, but that really wasn't the problem in the first place?
It's a mantra in the industry that the banks only go bust because of liquidity. They run short of funding. But the reason why the market denies funding to institutions is basically because they've made poor underwriting decisions. And everybody else other than the bank can see those poor underwriting decisions are coming home to roost, and so investors pull their money away before they get caught out and you know, the house of cards falls down. You don't change anything by putting in a ring fence or mandatory capital requirements. You know, basically, if people are going to make bad lending decisions, they're going to make them whatever. And I think ultimately that's the point that he's making. In this particular instance, it was bad lending decisions in the real estate market. And to be fair, we've seen those in previous cycles as well. It's obviously an Achilles heel for the industry.
Simon, one of the mantras that we've heard again and again from the government is that they would like to see increased competition in the banking sector. Has what you've heard so far and seen from the report, do you think that there will be much concrete in there which leads to that increased competition, particularly when they need quite high levels of capitalisation in order to see a new entrant come into the banking industry?
That's the critical point. Any new entrant coming in basically faces a wall of capital requirement well in excess of that which is applied to the existing players. It means it's impossible to enter the market on a price-led basis as a challenger there. It's also extremely difficult to actually get the license and get the authority to do business. And therefore, it might be wonderful if we opened up the industry and suddenly let 5 or 6 new regional banks come in and supply all this small business credit that regulators are saying is lacking. It's just simply the case that those same regulators are not going to let those banks enter into the market. So what we're going to see from the ICB and the reform is not structural change in the industry, but actually tinkering at the edges, things like potential account number portability and making it easier to switch your bank account.
OK, Simon, thank you very much indeed. Still with me is Simon Maughan, Head of Sales and Distribution at MF Global, and Elliott, Gotkine here in the studio. Let's just look at that issue, Simon, first, about whether or not banks are and should be supportive of the higher level of capitalisation than is necessary internationally. Is this something that's just going to skew that level playing field and make it harder for British banks to do business and be competitive?
Well, the whole pitch of the Vickers report is because we're only ring-fencing the business that you do in the European zone, you're going to be as competitive as anybody competing next to you. I think ideally Vickers would have recommended purely for the UK, and then there really would have been no risk that somebody from outside could come away and take your business, because they simply wouldn't have the on-the-ground staffing and branches. But because of EU law, they have to extend that ring fence out into the European zone, which increases the chance that the banks are at a slight competitive disadvantage. But the whole thrust of the report is that business which is genuinely international will be outside of the ring fence.
Simon, it's Elliott again. It's very easy to forget, of course, that the UK taxpayer owns more than 80% of Royal Bank of Scotland, more than 40% of Lloyds Banking Group. What does the ICB's recommendations do to the government's timetable for selling those stakes again and trying to get back some of the £85 billion or so that it put into those banks?
Well, not a lot directly. The key issue really for getting rid of those stakes is the resumption of ordinary dividends, and neither bank is in a position to do that right now because of the EU regulations and stipulations around the provision of state aid. Lloyds will be in a position to resume dividend payments from the beginning of next year. Royal Bank of Scotland from the second quarter, but there are some significant issues around the capital structure of Royal Bank that may mean that it's extremely difficult to resume dividend payments anytime soon. And that's actually the biggest issue, because without an ordinary dividend, you're not going to get private investors in the UK subscribing to shares. And without private sector and individual involvement, I don't think the government's going to sell the stake.
Simon, the Lloyds branches are still up for sale. Who is the most likely new entrant, or who is most likely to buy up those branches?
Well, my bias is towards NBNK, probably because I've had a greater discourse with them than the other players. But what I like about their offering is they appear to have the capital pledges in place to be able to afford this business. They're extremely well advised. They've thought very clearly about what the investment proposition is for investors getting involved in this bank, as well as dealing on a regular basis with both Lloyds and the regulators to ensure that they're basically hitting the ground running as and when they can take over these branches. So MBNK would be my personal favourite to take over these branches.
Simon, just as a final thought on all of this, obviously the bankers are at the House of Lords today. How much of this is really about politics, is about extracting some form of retribution for the bailout? The government does need to be able to sell this to voters, doesn't it, and show that they were able to really do something and change the way banking was done.
Well, I think the Lords today is less about political point scoring. One of the committee members did have a little bit of a go earlier on, and then came back later making the point that Vickers' estimates of the costs of the ring fence was roughly equivalent to the bonus payments for the banks, basically suggesting that they didn't pay a bonus in their investment bank in order to keep the flow of cheap credit to mortgages and small business going for a year. That's purely political point scoring. But when we come to the broader exercise and we actually get the House of Commons involved in passing legislation, then that's when you'll really see the political knives out. And there is a general feeling that nobody in the banking sector has been sufficiently punished for what's going on. So I still think the press, at least, that the banks have to suffer is going to be bad.
OK, as Simon Maughan, Head of Sales and Distribution at MF Global, thank you very much indeed for joining Elliott and I.